A guest checks out of a luxury resort on a Sunday morning after paying $900 a night for a suite with an ocean view. The front desk wishes her a safe flight, and the doors close behind her. As far as she knows, the transaction is over. It is not. The most profitable relationship the company has with that guest is only now beginning, and it will earn from her for years without renting her another room. To see why, separate two businesses that share one lobby. The first is the building itself, the marble, the pool, 400 staff, the surrounding land. The second is the name over the door. For most of the 20th century, these were one company that built a hotel, owned it, and ran it. Today, at the largest luxury operators, they have been surgically separated, and the split explains almost everything about where the money actually goes. The company whose logo hangs above the entrance usually does not own it, but something far lighter and richer. Consider the scale of the arrangement. The biggest branded operator in the world carries more than 1.7 million rooms under 30 brands, yet owns almost none of the real estate beneath them. Its rivals run the same way. Roughly 9 in 10 of their hotels are franchised to outside owners, and most of the rest are run under management contracts for someone else's account. The brand supplies the name, the reservation system, the standards, and the loyalty program. An outside investor supplies the $200 to $300 million required to build a flagship, along with the mortgage, taxes, and risk. This represents the asset-light model, and it has quietly become one of the most profitable structures in American enterprise. The brand company keeps earnings margins that a real estate owner can only dream about because it handed the heavy, slow, cyclical part to somebody else and kept the part that scales. This is Ownership Atlas, and today we are tracing a single guest's money from the moment she checks out to see who really profits from a luxury hotel and why the owner of the building is so often the last person paid. If you find it satisfying to watch a familiar business get taken apart to reveal who actually captures the cash, this is the channel that does exactly that, one industry at a time, so consider subscribing before the numbers get interesting. Start where the outsider always starts, with the room. A luxury hotel lives and dies on the metric the industry watches above all, revenue per available room, or RevPAR. It multiplies how full the hotel is by what each occupied room earns. In 2025, luxury was the one segment of American lodging with real pricing power, with average daily rates commonly running between $350 and $500, and RevPAR for the luxury tier rising about 3% for the year, driven entirely by rate rather than additional guests. So the room business is healthy. The trouble is, what happens to that $900 once it lands? Out of every dollar of total hotel revenue, only a portion survives as gross operating profit, the money remaining after paying to operate the property. Across the industry in 2025, that gross operating margin sat near 35%, and it has been falling for 3 straight years because labor, insurance, and other costs have climbed faster than room rates. For a luxury property, the squeeze is worse, not better, because service is the product. A resort promising a staff member the instant you want one is promising a payroll that never rests. Now, watch the deductions stack up against the owner. Before the owner sees a cent of profit, the brand takes its cut off the top line. A luxury franchise or management deal typically carries a royalty or base fee of several percent of room revenue, plus a marketing and reservation charge, plus a loyalty program assessment, plus if the brand is managing the hotel directly, an incentive fee on top. These fees are calculated on revenue, not profit. That distinction is the whole game. Even if the hotel has a terrible year and earns the owner nothing, the brand still collects because its fees are pinned to incoming revenue, not the money remaining. The party that sank $300 million into the ground carries the depreciation, the debt service, and the downside. The party that supplied the name carries almost none of it and gets paid first. It helps to see the two contract types the brand offers. because they determine how much control the owner retains. Under a franchise, the owner or a hired operator runs the hotel day to day and pays the brand a royalty for the flag and the booking system. Under a management agreement, common at the very top of the luxury market, the brand itself runs the hotel, hires the general manager, sets the service standards, and collects a base fee plus an incentive fee tied to profit. The management deal sounds friendlier because the incentive fee only pays when the hotel profits, yet the base fee still comes off revenue first. And the agreements can run for decades, with the brand holding approval rights over the owner's own budgets and renovations. An owner who signs a long management contract is renting out control of their own multi-hundred-million-dollar asset, and getting it back is expensive and slow because these contracts are written by the brand to be hard to break. The owner approves the budget in theory, but the brand shapes it in practice. Layer on the cost of the building itself. Property taxes on a trophy asset run into the millions a year and reset when the hotel changes hands. A luxury hotel must be renovated on a brutal clock because a suite that looked current 5 years ago now looks tired, and brand standards require the owner to spend the money to fix it, often a percentage of revenue set aside every year into a reserve for new carpet, new bathrooms, new lobbies. Then comes the mortgage. Buy a landmark hotel near the top of the market with heavy debt, and the interest payment alone can swallow whatever the operation earns. This is why a hotel can be jammed with affluent guests paying top rates and still deliver its owner a thin, nervous return, while the brand stapled to its roof compounds serenely. So if the room barely pays the owner, where is the real money in a luxury hotel company? Follow the guest after she checks out, and it appears. When she booked, she almost certainly used a loyalty account. At the big operators, loyalty members now account for the majority of room nights, and the largest programs have swelled past 250 million members each. The program looks, from the guest's seat, like a generous rewards club. From the company's seat, it is something entirely different. The program is a financial business in a hospitality costume. Here is the mechanism the industry rarely says out loud. The single largest revenue stream inside a modern hotel loyalty program is not room stays at all. It is the fee banks pay the brand for the right to print its points. The brand signs co-branded credit card agreements with card issuers. In the United States, the biggest hotel program works with two major banks at once. The bank pays the brand a large fixed sum at the deal start, and then variable payments every single month, based mostly on how much cardholders spend. Every time someone swipes that hotel-branded card at a gas station, a grocery store, or a restaurant, the bank hands a slice of that transaction to the hotel company. The guest does not have to sleep in a single hotel room for the brand to earn. She just has to spend anywhere on the card with the logo. The numbers are staggering once you look. The largest hotel operator told investors that the fees from its co-branded credit cards would climb about 35% in a single year to nearly $1 billion. Its intellectual property royalty income, the pure licensing of its name and its membership engine, reached over $700 million in 2025, up from about $410 million just 6 years earlier. This is money earned with no rooms, no housekeepers, no ocean view, no mortgage. It is the brand renting out its own reputation to a bank, and it carries a profit margin that ordinary hotel operations cannot approach. When executives call the loyalty program the crown jewel, this is what they mean. The stays feed the program feeds the banks, and the banks feed the brand. This is not one company's quirk, but the shape of the whole industry. A second global operator, the one behind another of the largest membership programs, carries well over $1 billion of deferred loyalty revenue on its books, most of it tied to its own guest program and its co-branded card arrangements, waiting to be recognized as members eventually travel. It too earns fees from card partners for the license to use its name and to issue its points, valued through the same kind of royalty accounting. Across the major branded operators, the pattern is identical. A lightweight company at the center licensing a membership base to the financial system, ringed by outside owners who supply the actual hotels. The names on the towers compete fiercely for guests, yet behind the front desks, they run the same money machinery. Understanding this reframes the entire industry. The brand is not really in the business of selling sleep. It is in the business of assembling the largest possible base of members, then monetizing that base through the financial system. For the largest asset-light hotel brands, hotel stays increasingly function as customer acquisition for a broader loyalty ecosystem. And it explains a strange fact. Loyalty members are worth far more to the brand than a one-time guest, not because they book slightly more often, but because they carry the card, and the card pays every month regardless of travel. The room opens the relationship, and the card is the annuity that keeps it valuable. The loyalty base does one more thing for the brand that shows up nowhere on a room bill. The base is the main weapon in a distribution war that taxes each hotel owner. Online travel agencies, the big booking websites, will happily fill a hotel's rooms, but they charge a commission that can reach 15 to 25% of the room rate for the privilege. A direct booking through the brand's own app or site costs a small fraction of that. Every room night, the loyalty program pulls into a direct channel instead of a commissioned one is money saved, and at the scale of a global brand, that gap is worth enormous sums. So the membership base is not only a financial annuity through the cards, it is also a moat against the booking platforms, a reason members book straight through the brand, which is exactly why the big operators guard their loyalty numbers so jealously and reward direct booking with perks. The independent luxury hotel without a membership engine has no such moat and pays the commission on far more of its rooms. Now flip to the side of the ledger the brand would rather you not examine, because this is where a real fight broke out in 2026. When a guest redeems her points for a free night, someone has to pay for that room. It is not the brand, but the owner of the individual hotel who surrenders a sellable room and accepts reimbursement from a pooled loyalty fund at a rate the program dictates. On a night when the hotel could have sold that room for cash, the owner often receives far less than the market rate for handing it to a points guest. The brand collected the card fees upstream at high margin with no hotel involved, while the redemption obligation landed downstream on a property whose profit was already thin. For years, brands told their owners the loyalty program roughly broke even for them. Then the largest operator disclosed that its card fees were headed toward $1 billion, and the owners did the math. In March of 2026, 51 owners representing nearly 1,000 hotels under one major brand signed a letter to that company's chief executive and chairman. Their message was blunt. They wanted a larger share of the money the loyalty program earns from the credit card partnerships, and they wanted the rules changed for how owners are reimbursed when guests cash in points. As they put it, owners were absorbing a growing share of the program's costs, while the brand captured a growing share of its revenue. This is not a small dispute between partners. That letter is a window into the whole structure. The people who own the buildings had been hosting the guests, absorbing the free nights and paying the fees, while the most lucrative part of the entire enterprise, the licensing of points to banks, flowed to a company that owns almost no hotels. The brand responded by raising owner compensation for award stays on the busiest nights, and by sharing some loyalty financials with owners for the very first time, a quiet acknowledgement that owners had been negotiating blind. The owner's squeeze does not end with points, because the most expensive part of luxury is the promise of service itself. A luxury flag sets standards the owner must fund, the staffing ratios, the turn-down service, the concierge, the money-losing restaurant the brand requires. Labor is the heaviest single cost in a full-service hotel, and in recent years, it has climbed faster than room rates, which is the main reason gross operating margins have slipped 3 years running. When a brand raises a service standard, it is often the owner who pays for the extra staff, while the brand collects its fee on the revenue that standard is meant to protect. Then there are the capital demands. Every several years, the brand issues a property improvement plan, a required list of renovations the owner must complete to keep the flag, and for a luxury hotel, that can mean tens of millions of dollars in new rooms, lobbies, and systems. Refuse, and the brand can pull the name, which can strip the hotel of its demand overnight. The owner is a partner who cannot say no, bound to a standard set by a company that does not share the renovation bill. There is one more layer, and it is the most financial of all. Those hundreds of millions of members hold points the brand has not yet honored, a running promise of future free nights. That promise sits on the balance sheet as a liability of many billions of dollars, and the brand manages it the way a banker manages deposits. A crucial input is breakage, the share of points the company estimates will never be redeemed at all. The largest operator has disclosed that a change of just 1 percentage point in its breakage assumption would move its loyalty liability by roughly $50 million. That single assumption changes everything. A single quiet assumption about how many members will forget, lapse, or die holding unused points swings the company's obligations by tens of millions. Programs do not actually want zero redemption because points nobody uses eventually feel worthless, and members stop chasing the card. What they want is controlled redemption, enough to keep the currency believable, not so much that it becomes expensive, adjusted over time through devaluation, the slow raising of how many points a free night costs. The card is not even the only way the name earns without a room. Luxury brands now license their names onto condominiums. The branded residences you see rising beside a flagship hotel, a developer pays the brand a licensing fee to call the tower a residence by that famous name, and buyers pay a premium to own a home wearing it. The brand collects for the name and often for managing the building's services, again with no ownership of the concrete and no hotel room involved. The residence is the same trick as the credit card. Applied to real estate, the brand never buys. Every one of these streams has the same defining feature. No stream requires the brand to own a hotel, and each one grows with the strength of the reputation rather than the size of the building. Let me show you the split with a simplified model, clearly hypothetical, built to illustrate rather than to describe any single real hotel. Picture a 200-room luxury property. Assume it runs at 70% occupancy at an average daily rate of $450. That is about $23 million a year in room revenue, and with food, spa, and events, call it $35 million in total revenue. At a 35% gross operating margin, the hotel produces roughly $12 million before the big deductions. Now the brand's fees come off the top, base and franchise and loyalty and incentive charges that on a luxury deal can total somewhere between 8 and 12% of revenue. Several million dollars gone before the owner's own costs are counted. Subtract the annual renovation reserve, often 4 to 5% of revenue set aside for the brand-required refresh, and property taxes and insurance running into the millions. What remains is the owner's operating profit, and against that, the owner still owes the mortgage on a building that may have cost $250 million. In a strong year, the owner clears a real but modest return on an enormous check. In a soft year, when RevPAR dips a few points and costs do not, the same building can hand its owner almost nothing, while every fee tied to revenue keeps flowing to the brand. Run the identical guest through the brand's books and the picture inverts. The brand collected its percentage Of that $35 million in revenue without owning a brick, it also collected a loyalty assessment. It booked a slice of the card spending that guest and millions like her generated all year on the co-branded card. It recognized licensing income on the points it sold to the bank. Its costs were software, marketing, and a modest staff, not marble and mortgages. The same guest, the same stay, produced a thin, leveraged, cyclical return for the owner and a substantial, capital-light, compounding return for the brand. That gap is not an accident. It is the business model, refined over 2 decades and defended relentlessly, which raises the question every hotel investor eventually faces. If the brand keeps the best economics, why does anyone own the building at all? Because the brand delivers something an independent owner cannot easily replicate: a fire hose of demand. The reservation system, the loyalty base, the global marketing, and the search dominance fill rooms that a standalone luxury hotel would struggle to fill alone. The owner is buying distribution and paying for it in fees. The calculation that decides success is whether the demand the brand brings, the higher rates and occupancy a flag can command, more than covers the fees, the renovation demands, and the loss of control that come with it. Sometimes it does, especially for a well-located asset in a market where the brand's guests want to be. Sometimes it does not, and the owner would have kept more by going independent and spending the fee money on their own marketing. Here is a genuine trade-off worth your thoughts in the comments. Suppose you own a strong luxury hotel and your brand contract is expiring. You can re-sign and keep the flag, accepting fees near 10% of revenue and the loyalty rules you cannot control, in exchange for the demand machine that keeps you full. Or you can go independent, keep every dollar of fees and the freedom to price and renovate on your own terms, but rebuild your entire booking engine from scratch and risk emptier rooms. Which do you choose? The guaranteed demand at a permanent tax, or the freedom with the risk? And what would make you switch? Watch how the two businesses behave when the economy turns, because that is where the design reveals its logic. When a recession hits, luxury travel softens, RevPAR falls, and the owner feels it immediately and violently. Occupancy drops, rate drops, but the mortgage, the taxes, and the fixed payroll do not, so the owner's thin margin can vanish or go negative fast. The brand feels the same downturn far more gently. Its fee income dips with revenue, yes, but its card licensing money keeps arriving because people keep spending on the card even when they travel less, and its costs never included the building in the first place. During the deepest travel collapses of recent history, the biggest brands raised cash by selling future loyalty points to their card partners in advance, turning the program into a source of emergency liquidity that a mere hotel owner could never tap. The asset-light company bends, while the asset-heavy owner can break. The ways owners actually lose in this business line up in a pattern once you know where to look. They pay a trophy price near the top of a cycle and finance it with heavy debt size to peak year revenue. So the first soft year turns the mortgage into a trap. They underwrite the room revenue and forget the fee stack, the loyalty and management charges that come off the top no matter what the hotel earns. Others sign a long management contract for the demand and discover they have surrendered control of their own budget for decades. They also treat a full glamorous lobby as proof of profit when the profit was quietly draining into fees, renovations, and free nights they were required to honor below cost. None of these mistakes shows up in the occupancy report, which can look wonderful while the owner's bank account does not, because the metric that fills the room is not the metric that pays the owner. So the opening question answers itself. Why does a luxury hotel make more money after you check out? Because for the company whose name is on the building, the stay was never the main event. The stay enrolls you, brands you, and hands you a card, and the card is what pays month after month, regardless of whether you ever return. The room is a marketing expense for a licensing and payments business, whose true product is a membership base rented to the banking system. Three variables decide who wins in this business, and none of them is how full the hotel looks. The first is who owns the fee stream, the brand that licenses the name or the investor that owns the walls. The second is how much of the loyalty economics, the card fees, and the point sales a party actually captures versus how much it merely funds. The third is the fixed weight underneath, the debt and the renovation clock that fall entirely on the owner and never on the brand. Ownership of a luxury hotel can absolutely work when the asset is irreplaceable, the debt is sane, and the brand's demand genuinely earns its fees. It turns dangerous when an owner pays a trophy price with heavy debt, mistakes a full lobby for a fat profit, and forgets that the most valuable thing in the building was never the suite with the ocean view. It was the guest's signature on a loyalty form, and it kept earning long after she flew home.